If you're a business owner, there is a way that you can only pay tax on 80% of your income rather than 100% of your income. If you like this video and the content in it, I would appreciate it if you would hit the subscribe button below and subscribe to my channel. So let's talk about what is called the Qualified Business Income Deduction, which is usually shortened to QBID, the QBID, QBID. It is a deduction that applies only to business owners and allows them to only be taxed on 80% of their business income rather than 100% of their business income. So this applies to sole proprietors, partners in a partnership, and owners in an S corporation. It gives them a 20% deduction of their business income on the tax return. And it has certain phase outs. So these phase outs, so if you're an individual, so this would be if you file single or married filing separately, then it is a $164,900 to $214,900 is the phase out for those. If you file a married filing joint return, then the phase out is $329,800 to $429,800. So what that means is if you don't file as a married filing joint and your income is $165,000 or less, then you would get the full deduction. You would, or at least you would qualify for the full deduction. There's a complicated calculation that goes into it based on your taxable income and other things, but you would qualify for a full 20% deduction of your business income, whether that came from a sole proprietor from like a Schedule C, or if it came from a partnership, or if it was S corporation income. Same thing applies if you file a married filing joint and your income is roughly that $330,000 or below, then you would also qualify for the full 20% deduction on your return. Once you start to get into the phase-out numbers between, say, 165 for individuals and 215,000 and 330 for married, all the way up to 430 for married people, once you're in that phase-out period, then you start to see that deduction potentially phase out depending on various factors. And once you go above the phase out threshold, then you only get that deduction for special circumstances and special places and special ways. So let's talk a little bit about that phase out. So when you're in that phase out period, how does that apply? How does that work? Well, a lot of it relies on this SSTB. SSTB means a specified service, trade, or business. So the IRS has come up with special trades or businesses that don't apply, that don't get the qualified business income deduction. Those specialized service trades or businesses applies to doctors, lawyers, accountants, consultants, financial advisors, and people in similar professions. Once their income goes over these thresholds, the 215 for individuals and 430 for married, again, those are the 2021 phase out numbers, they no longer get any of the QBID. It is gone completely for them because the IRS, I guess, deems that since they do service and that service is based on the work that they do, that they don't get that deduction. It seems unfair. Being an accountant, I don't think it's very fair that phases out, especially for doctors and other people that provide specialized services. But anyway, that's the way the law was written and the way the law is. So people in those specified service trades or businesses do not get this deduction at all if their income's over that. I work with a number of doctors, and unfortunately, they have S corps and partnerships and other things, and they get zero of this deduction. So that's the sad thing for them. But again, if you're under those thresholds, everybody gets it. So a doctor that's under 330 of income during the year, they would qualify for the full QBID. Once they get into this phase-out range, then it depends on how far they are into that phase-out of how much that they would actually get. So somebody on the higher end of the phase-out would get less than somebody that was on the lower end of the phase-out. So that's how it works for a specialized or specified service trade or business. Now, if you're not in a specified service trade or business, the phase-out still applies. And the cap here at the top applies as well. So what happens is when you start to get into this phase out and beyond the phase out, if you're not in a specified service, trade, or business, then it starts to be dependent on the wages that you pay in your business and the property that you own in your business. There's a complicated calculation that goes into that, but basically, let's say that you own a manufacturing business. So you're not a specified service trader business and you're making $500,000 a year, you're above that threshold. So is what the calculation does, it looks at how much you pay in wages and how much property you own in your business property. So business property would be things that you'd appreciate, such as your equipment that you have, vehicles, other sort of property like that. It looks at how much you own in property and how much you pay in wages each year, and then allows you to get the qualified business income deduction based on how much of those numbers that you have, how much wages you pay, how much property that you own. So somebody that's making $500,000, $1 million, $2 million, $3 million, they can still qualify for the qualified business income deduction. It just is dependent upon, again, wages and property they own. Whereas a doctor or somebody that's in a specified service trader business, once they're above that threshold, it completely phases out for them. So that is the qualified business income deduction. Again, it's a great way for business owners to save a significant amount of money. You'll notice I didn't say C corporations in this. C corporations do not qualify for the qualified business income deduction because C corporations got a tremendous benefit in the 2017 tax law, the Tax Cuts and Jobs Act, where the corporate tax rate went from 35% down to 21%. As part of that tax law, small business owners that own sole proprietors, partnerships, and S-corps, they said, hey, what about us? That's not fair that C corporation tax rates go down, but we don't get anything. So the qualified business income deduction was what they came up for those business owners to help them save. So C corporations don't get it because they have a lower corporate tax rate, but business owners do get that. So that's how the qualified business income deduction works and how it helps business owners to save money on taxes. If you enjoyed this video, please consider hitting the subscribe button below. Thank you.